Hello and welcome back to Principles of Accounting 1. I'm your host, Dr. B. We made it to the second week of our spring 2022 semester here at UDC. So happy to have all of you with me today. Before we jump into the third chapter, which is what we're about to talk about, adjusting entries, real quick housekeeping notes where we are in the classroom. Open up Blackboard under course content, module 1. We're in week 2. So Blackboard course content module 1. We're currently entering week 2. I know. It's amazing. We made it this far. Also, I just want to quickly talk about week 1. Real fast. All of you completed Chapter 1 quiz. I think there's one or two of you that didn't complete the Chapter 2 homework for whatever reason. I don't know why you didn't, but if you didn't, please make sure that you get it in right away, since, we are in almost the middle of week 2 already. This course goes by really fast. It's only 8 weeks. There are 2 chapters in every single week. So please, if for whatever reason you fall a little bit behind, just make sure you get caught up quickly, because that will don't miss anything. Because remember, each quiz and each homework assignment is worth 5% of your total grade. That's half a letter grade. Don't skip anything in this course. If you skip something, that will be very, very dangerous for your grade. We want to make sure that you do the best you can. So please, please, please don't miss anything in the course. Make sure that you complete all of the work. There are 2 attempts on each quiz and each homework assignment, as I had mentioned earlier. So please make sure that you take full opportunity of that and try to earn the highest grade possible. If you run into trouble with the content, you don't understand something, you are you need more clarification, you have options. Okay. Number 1, you could set up office hours with me. Go into the classroom, select the office hours link, set up office hours with me. Number 2, there is tutoring available for this course with Dr. Remy. If you want tutoring for this course, Dr. Remy is a great resource as well. So you can select the tutoring link, set up office hours with Dr. Remy. So you got tutoring, you got office hours. You have me. You can email me and say, hey, Dr. B, I don't get this. Can you help me to understand it more? Whatever it takes. You could, but definitely set up office hours for sure. I'm here to help you. I want you to understand the content, especially this early on. Chapter 1, Chapter 2, Chapter 3, Chapter 4. This is all the accounting cycle. You really need to understand the accounting cycle, how to make journal entries, how to get your debits and credits to balance. So important that you understand those concepts, because the rest of the course builds on that information. And that's why we really need to make sure that you understand the content early on, because the rest of the course builds on these first 4 chapters. So if you're having trouble understanding any of that content, reach out to me, set up office hours, get some tutoring with Dr. Remy, email me, whatever it takes. I will get you through it. But I need to know that you're having trouble, right? If I don't know, I can't help you. So if you're having trouble with understanding any of the content, let me know. And I'll be happy to work with you. Okay, so that was week 1. Right now, we're about to jump into Chapter 3, which is about adjusting journal entries. And then we'll jump into Chapter 4, which is going to be closing out the accounting cycle. So without further ado, let's jump into adjusting entries. We call these adjusting accounts for financial statements. The concept here is at the end of the month, at the end of the quarter, at the end of half a year, at the end of a year, we make these things called adjusting journal entries. And what we're doing with adjusting journal entries is we are doing a couple things. Number one, we make adjusting the journal entries to make any corrections to accounts if there needs to be a correction. Maybe we made an error in an earlier journal entry. We can fix it with an adjusting journal entry. The other reason why we do adjusting journal entries is to recognize the consumption of an expense over time. And another reason might be we are recognizing revenue that we earned from unearned revenue. That, a customer paid us in advance, so we got the payment, but we haven't performed the service. When we perform the service, we need to make an adjusting journal entry at the end of that month to recognize that we've earned that revenue. And that's what we're going to talk about today. That's the process of what we call adjusting journal entries. So we'll talk about the accounting periods. We'll talk about how to make the adjusting entries, and I'll walk you through the process. Okay. So let's talk about the accounting periods. An accounting period is an amount of time specified. It could be a month. It could be a quarter, half a year, or a year. We call these accounting periods. Typically, in a business, we operate every single month. And at the end of every single month, we would make adjusting journal entries to what happened in that month. We recognize at the end of each month, we go through this thing called the closing process. And what we do is we reconcile our accounts. We match them with our bank statements, with our accounting books, and we verify that they're correct. And we do that at the end of every single month. And then we create a final version of the income statement, balance sheet, statement of cash flow, statement of retained earnings. And we do that every single month. And we do that every month throughout the year. We can also report that information based on a quarter, half a year, year. We could report the income statement, balance sheet, statement of cash flow, statement of retained earnings at the end of those accounting periods. It's helpful to do that because the managers, the stockholders, the other parties involved would be interested to see the accounting information displayed monthly, quarterly, semi-annual, and annual. And all of that information is helpful during those accounting periods to help accountants and managers to really understand the financial data of what happened during that time period. There are two types of accounting. There's what we call accrual-based accounting and cash-based accounting. When you set up your business, when you set up your catering business, or you set up your retail business, online sales, whatever it is that you're all doing, I know you're all having some fun with your businesses. You need to make a decision on how you're going to when you're going to record your revenue and expenses. And that depends on the type of business you're running and when you want to see that type of information. And the decision is you either have to go with the accrual-based accounting system or the cash-based accounting system. Now, here are the differences. Accrual-based accounting is when we record revenue when it's earned. When it's earned. Revenue is earned when we have either delivered the goods or provided the service. That's earned revenue. Revenue is earned when we deliver the good or provide the service. In accrual-based accounting, we recognize revenue when it's earned. We also record expenses when they are incurred. Here's what that means. If I have an electric bill in front of me and it's for the month of December, I need to record that expense in the month of December because I incurred the electric in December. So I need to match that expense when it happened. That's what accrual-based accounting tells us. I record revenue when I've earned it, and I record the expenses when I've incurred them. That's accrual-based accounting. Accrual-based accounting involves accounts like accounts receivable and accounts payable. That's what it means to accrue. I can accrue a receivable, earn the revenue over time, but have not yet received cash. I can also accrue expenses. Accounts payable. I received the bill, haven't yet paid it. I have employees that worked, have not yet paid them. Wages payable. I collected taxes, have not yet paid them. Taxes payable. That's all accrual-based accounting. So that's option one. And that's what most businesses do. They use accrual-based accounting. The other reason is because it's generally it's GAAP compliant, U.S. GAAP compliant, which is generally accepted accounting principles compliant for taxation reasons. The other option is to use cash-based accounting. Cash-based accounting is different from accrual-based accounting because we recognize the revenue and expenses at different times. In cash-based accounting, we recognize the revenue when we receive the cash, not necessarily when we perform the good or the service. So cash-based accounting is based on cash. We record revenue when we receive the cash. And we also record expenses when we pay cash for the bill. Okay? Obviously, that's different. Revenue when cash is received in cash-based accounting. In accrual, it's when I deliver the good or the service, not necessarily when I receive the cash. Expenses in cash-based accounting is when I pay the bill, not when I incur the expense. For example, with the electric bill. With the electric bill I received in January, it was for electric I consumed in December. Under accrual-based accounting, I need to record that bill for the month of December. In cash-based accounting, I would record that for January. That's the difference, okay? When you read the report, the income statement for accrual-based accounting will say that I incurred the expense in December. But if I receive the bill in January under the cash-based system, the income statement will say I incurred the expense in January. But which obviously wouldn't be the case. Victoria.
Professor.
Yes, please.
That's kind of mean like you pay a month after the services.
That's right.
Okay.
That's the way it reads on the cash based accounting system. It looks like I incurred it in January, but the reality is I incurred it in December. So that's why most businesses, they use the accrual-based system. Some use the cash-based system, and here's the ones that do it, right? So think about the different types of businesses out there. The ones that would use the accrual-based system would be the ones that have accounts receivable and accounts payable. Like, for example, oh, my customer pays me 30 days later after they receive the good or the service. That would be an accrual-based type of business. A cash-based type of business would be like a restaurant, a hair salon, a barber shop. Those are cash-based businesses. They primarily deal with cash-paying customers. They receive cash at the time of the sale.
Professor, I have a question, please.
Miss Edwards, yes, please.
I have a question. Most utility bills, they accrual basis.
Yes, that's correct.
Okay. Thank you.
Yep, good question. Yeah, it's accrued based off of the for the usage, and then they send you the bill after the fact. Yeah, that's right. That's accrual based. Good, great question. So those are the differences between the two systems. Any questions? Make sense?
Are there any things that are, what are some businesses that have to be recorded as cash businesses or vice versa? Maybe just a couple examples.
Yes, sure, Zach. Thanks for the question. Most businesses are accrual based. The government is accrual based. Most nonprofits are accrual based. Most retailers are accrual based. They use accrual based systems because of their customers. They have customers that pay later, typically. They'll say they'll receive the goods and services, but they won't yet pay the company until usually like 30 days later or whenever, because they receive a bill, basically. Those types of businesses that send a bill to their customer for payment, they're accrual based. Cash based businesses would be like a barber shop, a hair salon, uh, a restaurant. Their customers usually pay them in cash at the time of the service. So
Thank
that's
you.
really the difference. You're welcome. Any other questions? Good so far, yeah.
So basically accrual basis are basically loans. Like
No,
if you can work out a payment plan, like is the payment is not needed right now. You can pay, as long as you got an agreement with that company when you can pay it. That's accrual basis, and cash basis is basically I need my money now after you receive your service.
kind of. I mean, so that's a little different actually. The way to think about it is with accrual based systems, usually the company will send a bill to their customer and they'll pay later on. You know, just like let's say Makia, you come to me and you say, "Hey, Dr. B, I want to order a textbook from you." Okay, great. I send you the textbook, and along with the textbook, I send you a bill, and the bill says, "Pay me within 30 days," because that's how my business operates, right? That would be an accrual based system. You would pay 30 days later, and that's it. You know, that's how my business works. On the cash side of things, you go to a restaurant after you've consumed your meal, you pay the bill, right? You pay it right then and there. So that's the difference
Professor,
from a customer perspective.
I have a question. Accrual basis almost sounds like credit, but I kind of do see the kind of difference though. Accrual basis would be closer to credit the way I see it.
Yeah,
Not exactly, but somewhat.
yeah. That's a good way of looking at it, Miss Edwards, and that's an excellent way of thinking about it. Yeah, very true.
Thank you, Professor.
Thank you. Yeah, good questions. So let's talk a little bit more about this concept. A couple of examples here. Insurance. I think I gave this example once, but so let's say I personally pay my car insurance for the full year. Okay, that's just me. That's what I do. You know, when I get the bill every year, I pay the full bill, and that covers the whole year worth of insurance expense. Okay. For the company, that's called prepaid insurance. Prepaid insurance. I'm paying the entire year up front. Okay? That's called prepaid insurance. I paid it before I've incurred that expense. So I send the check off for the whole year. It covers the whole year. At the end of each month, the insurance company makes an adjusting journal entry. We debit insurance expense and credit prepaid insurance. And what that's doing is it's recognizing the consumption of that prepayment, that prepaid piece. Make sense? So I pay it up front. It's prepaid insurance. At the end of each month, I need to recognize that expense being consumed. So I'll debit insurance expense and credit prepaid insurance. And that's accrual based, right? So on the accrual basis, I'm recognizing the consumption of $100 per month of insurance. If I pay, let's say I pay 2 years worth of insurance. Okay, in this example, I pay 2 years of insurance. It's $2,400. If $2,400 divided by 24 months, it's $100 a month. So using the accrual-based system, I would recognize an insurance expense of $100 at the end of each month. Because using the accrual-based system, I need to recognize the expense when it's incurred. When it's incurred, when it's consumed, when it's incurred. So I recognize a $100 insurance expense at the end of each month. Debit insurance expense, $100. Credit prepaid insurance, $100. That's the adjusting journal entry I would make at the end of every single month for 24 months. That's how I recognize the consumption of the insurance expense. And we see that I'm allocating $100 to each month for the 24 months. That's the policy coverage. That's accrual-based accounting, right? I'm recognizing a $100 expense every month for the 24 months. Because based off of accrual-based accounting, I need to recognize the expense when it's incurred. The difference is, in cash-based accounting, I would recognize the entire $2,400 of insurance when I paid it. In this case, December of 2019. It covers 24 months, but because it's cash-based accounting, I don't recognize the expense when it's incurred. I only recognize it when I paid it. That's why for businesses, it's very important that they select one or the other and stick with it. And it makes the reporting different, right? On the income statement for the month of December in 2019, using the cash-based accounting system, I would see an expense for insurance for $2,400. If I used the accrual-based accounting system, I would see an expense for insurance for $100. And I would see that same $100 expense for the next 24 months. Make sense?
Yes.
Yes, sir.
Great. Awesome. Thank you so much. Thank you so much. And that's what that's the difference between cash and accrual based accounting. With accrual-based accounting, we recognize revenue, which is what we get for income from our customers from sales of goods and services. We recognize that revenue when it's earned. That's when we've delivered the good or the service to the customer. We recognize revenue when it is earned. Okay? That's accrual-based accounting. In cash-based accounting, we recognize revenue when cash is received. So that's the primary difference with revenue. Recognizing revenue in the accrual-based system, we recognize it when it's earned. We've delivered the good or the service. In the cash-based system, we recognize it when we receive the cash. So that's the primary difference between the two. With expenses in the accrual system, we recognize expenses when they are incurred. That means we record the expense for the month that I incurred that expense. The electric bill, right? Got my electric bill a few days ago. It was for the month of December. Okay? I need to make an adjusting journal entry for the month of December. I'll date it December 31st of the previous year to get the expense into that month, because that's when I used the electric. Okay, I'm recognizing the expense when it was incurred or when it was consumed. Yeah. That's the accrual-based accounting system. In the cash-based accounting system, I would receive my electric bill a few days ago. It's January of 2022. I would say, oh, January 2022. There's my electric expense for January 2022. That's the difference, right? But the overall... Yes, please, Victoria.
Yes, Professor. I want to know, okay, like utilities.
Mm-hmm.
I wonder sometimes is that paid on an accrual basis, because a utility bill at the end of the month is not always the same amount.
That's right.
So,
Yeah, it's
I
based
was
on
thinking maybe
consumption.
that's why that's paid that way.
Exactly.
It's done that way. Okay.
Exactly right. Yeah, that's what we call accrual, right? So we're accruing that expense for the month. So when you get your bill and it shows the electric you consumed for the previous month, it's accrued. It's an accrued expense. They record the expense each day that you're using the electric for the month. That's called accrual. Yep, exactly right. That's a great way of thinking about it. Yeah. But the overall point is, according to the matching principle, we need to match the expenses when they happen, along with the revenue of when it happened. Michael, you good?
Yes.
You good? Okay.
Good, sir. Sorry.
Awesome. That's all right. No worries. Just wanted to make sure everything was all right. Okay. Adjusting entries. Let's talk about adjusting entries. Earlier I had said we make adjusting journal entries at the end of each month for a specific reason. Okay? There's a couple reasons. There's a couple reasons why we do it. One is for what we call deferral of expenses. Deferral of expenses. When you defer something, it means you're putting it off, right? Deferring it. I'm deferring that until next month. You're putting it off. That's what deferral means. So, with a deferral of expenses, what that means is I'm not recognizing the expense until later on. Okay. Example. I prepaid my insurance for the year. Okay. Wrote the insurance company a check for the whole year, right? I have not yet recognized that expense. I don't recognize it because remember, any prepaid account, that is an asset account, right? Prepaid insurance, that is an asset account. It becomes an expense when it is incurred. Okay? So at the end of January, since I prepaid the insurance for the year, at the end of January, I will record an adjusting journal entry. So on January 30, which I think 31, 30, whatever, I will record a debit to insurance expense and a credit to prepaid insurance. What that adjusting journal entry does is it increases the expense, recognizing the expense, right? And I'm decreasing the prepaid account. I'm consuming because I've consumed a whole month of insurance. That's a deferral of expense. Another one's called deferral of revenue. Deferral of revenue. Here's what happens. Deferral of revenue entries. We have a remember that we have a lawn service business. You might remember this from last week. We have a lawn service business. And in our lawn service business, we have customers that pay us in advance for the season. Okay? That is unearned revenue. Unearned revenue. The customer pays me before I deliver the good or the service. That is called unearned revenue. Because remember, with accrual-based accounting, it becomes earned revenue when I deliver the good or the service. So if a customer prepays me for the season, I have not yet mowed their lawn, that is unearned revenue. It becomes earned revenue after I mow the lawn. Okay, so here's how it works. Customer pays me in advance. That's unearned revenue. So I debit cash to increase cash, and I credit unearned revenue to increase unearned revenue, which is a liability account. After the month, at the end of the month, I probably mowed their lawn 2-3 times, right? 4 times, maybe. At the end of the month, it became partially earned revenue. So at the end of the month, I make an adjusting journal entry. I debit unearned revenue, and I credit revenue to recognize that I'm earning the revenue for that month. So that's deferral of revenue. The third type of adjusting journal entry is called an accrued expense. Okay, here's how this one works. Accrued expense. I have an employee. Okay, the employee works. I know, right? That's how it's supposed to work. Employee works. They work for 2 weeks. At the end of the 2 weeks, I pay them for the hours worked. Okay? You get paid every 2 weeks. Most people do. Okay? That's called accrued. It's an accrual. You're accruing hours when you're working, right? If you work 8 hours today, you accrued the 8 hours for today. And you'll do the same thing again tomorrow, the day after that, for 2 weeks. And then eventually you'll get paid. That's called an accrued expense. The employer accrues the wage expense. So, in that adjusting journal entry, we debit wage expense and we credit wages payable. It's to represent the accrual of that expense. That's just one example of a few. The fourth type of adjusting journal entry is called accrued revenue. Accrued revenue. Accrued revenue is very similar to deferred revenue. The difference here is that over the month, I've been receiving revenue, but I have not yet recorded it. This happens with like a convenience store type business. They won't record their revenue until the end of the month. They go through all the receipts and they add everything up, okay? And then they record the revenue at the end of the month based off of their receipts. That's called accrued revenue. It's these days it's all computerized, right? So no one's actually sitting there adding things up, but the computer's doing that for them. But they don't recognize the revenue until the end of the month. That's called accrued revenue. They built it up. Yeah. And those are the four different types of transactions for adjusting journal entries. We adjust the journal entry in 3 steps. First, figure out what happened. What's the current account balance? Second part is what should it be equal to? The third is record the entry. And then you go through the steps again. It's easy. It's very easy. Let me show you. Okay, sorry, it's a little blurry. I'm just seeing this now. Prepaid expenses. I prepay my insurance for the year. Okay, that's a prepaid expense, which is an asset. Yeah. Prepaid insurance, prepaid rent, prepaid supplies. Yeah, I guess so. We debit throughout the month when we recognize it. When we recognize it, we debit insurance expense and we credit prepaid insurance to recognize the expense at the end of each month. That's the adjusting journal entry. So we've identified what has happened. We prepaid our insurance. We identify what has happened. We prepaid our insurance for 24 months in this example. So I debit prepaid insurance, credit cash. That's when I prepaid my insurance. Now, at the end of the month, I need to recognize the consumption of that insurance. So I would debit my insurance expense by $100, and I would credit my prepaid insurance by $100. Now I would do that same adjusting journal entry transaction at the end of each month for 24 months till it reaches a balance of 0 on the prepaid insurance. That's the adjusting entry. We see that at the end of each month on your balance sheet, your prepaid insurance account goes down until it reaches a balance of 0 at the end of 24 months. And each month, your insurance expense goes up by $100. At the end of the month, or I'm sorry, at the end of the year, end of the first month, December 2019, for the month of December in 2019, I consumed $100 of that insurance expense, so that was prepaid. So I would debit insurance expense and credit prepaid insurance. We do that at the end of the month. Remember, these are adjusting journal entries. The purpose of adjusting journal entries are to recognize the consumption of an expense or to recognize what had happened that has not yet been recorded. That's the purpose of adjusting entries. Here's another example. It looks like what did I do? I prepaid, I I purchased some supplies, $9,720 worth, that were used in the month of December. Okay, so I'm consuming supplies. When I consume supplies, let's say it's like office supplies, or let's say I'm using my own inventory. This is typical, right? So let's say you have a retail store, and at your retail store, you do demonstrations with some of your products. You're using your inventory, right, to do those demonstrations. You need to take that out of inventory. So you would debit supplies expense and credit supplies to reduce your inventory and to increase your expense. And this shows us the effect on the balance sheet over time and the effect on the income statement over time. So again, I consumed my supplies. Debit, supplies expense, credit supplies. And you see the note here, to record supplies used, right? This is an adjusting journal entry. Recognize something that happened during that month. Oh, depreciation. Depreciation. Let's talk about this briefly. Depreciation. This is a very detailed subject. There's a whole chapter on it. But I'm going to talk about it very briefly, just so you understand the basic concept of depreciation. Over time, assets lose their usefulness, right? Your car breaks down. The building falls apart. The equipment falls apart. Uses its usefulness over time. That's normal, okay? That normally happens. Your car's going to break down. That's the nature of cars. They get older. Things happen to them. The tires wear out. The brakes no longer work, whatever, right? That's normal. Machinery breaks down over time, gets older. Long time ago, when I was working in the hotel business, I had a chiller on the roof. The chiller broke. It's a machine. Machines break. Equipment breaks. Buildings deteriorate. Normal stuff, okay? So, in accounting, we need to recognize this. We do that through this process called depreciation expense. Okay? We depreciate the value of the equipment, the property, plant, and equipment. We depreciate the value over its useful life. Okay? The IRS comes out with this thing called the depreciation schedule every year. And it tells businesses how the average useful life of their assets. How long does a vehicle last? How long does the equipment last? How long does the building last? That's called useful life. How long it's expected to be useful. You know? And so what we do as business owners, we depreciate the value of our assets over their useful lives. For example, let's say I have a business and I have a dump truck. The dump truck cost me $25,000. According to the IRS, the dump truck is supposed to last me for 5 years. So I would depreciate the value of that dump truck over 5 years by the same amount. We call that straight line depreciation. So the way I do it is I debit depreciation expense and credit this thing called accumulated depreciation. We're reducing the value of the asset over time. So the formula for straight line depreciation is the asset cost minus salvage value divided by useful life. The cost of the asset is $25,000. I bought the dump truck for $25,000. Its salvage value is $0. $25,000 minus $0 is $25,000. IRS schedule useful life, 5 years. 25,000 divided by 5 is 25,000. So $5,000 a year. 25,000 minus 0 divided by 5 years is $5,000 per year that I would depreciate that vehicle. Okay. So December 31 comes around, I make a journal entry. Debit depreciation expense, 5,000. Credit accumulated depreciation, 5,000. Accumulated depreciation is what we call a contra flow account. And it holds a negative balance as an asset account. That's how we reduce the value of the vehicle.
Professor,
Professor,
I have a quick question.
Yes, please.
Okay, so could you kind of would you kind of say depreciation is kind of example of, if we use car as an example, can we use Kelly Blue Book as a depreciation, or?
Great question. So kind of. Every type of asset is treated a little bit differently, but usually, if you're using a car for your business, what you need to do is you take the cost you use to purchase that vehicle with. That's your asset cost. The salvage value is what Kelly Blue Book would say it's worth. Okay, the salvage values is what it's worth at the end of its useful life. At the end of its useful life, the useful life is determined by the IRS. There's according to IRS.gov, there's it's called the Schedule of Depreciation, and it shows you how long things are supposed to last according to the IRS. Now we know that car is going to last longer than 5 years. The IRS, for depreciation purposes, says it lasts for 5 years. Good question.
Professor, I have a question pertaining to what you had just said.
Ms. Edwards, yes.
Okay, in the same scenario,
Mhm.
you said if it's $25,000 is worth.
Yes, ma'am.
Within 5 years, they will have to depreciate it by 5,000. Does
Correct.
it go down like that? 10 years, depreciated by 10,000, 15 years, and so on. Does it go down like that?
No, it doesn't. It's based off of the useful life. So the IRS tells us how long the useful life is. So if I purchased it for 25,000, 25,000 is the asset cost. The salvage value is 0. It's probably not 0, but for this example, it's 0. Salvage value is what is the asset worth at the end of its useful life. So 25,000 is my cost. Salvage value is 0. The IRS said the useful life is 5 years. So the only way to do this is 25,000 divided by 5 years. When it reaches the end of year 5, it is worth nothing, according to the IRS. And that's when I remove it from my books.
You know, Professor,
Yes, ma'am.
I kind of get it, because I guess within say like if it's another 5 years, the truck probably would not be quite as good as it was
It'll still
the
work.
previous 5
It'll be
years
worth
before,
nothing.
right?
Yeah, it'll still work, but it'll be worth nothing. I won't be able to depreciate it anymore because it's reached the end of its useful life. But I can still use it. It'll just be a straight expense at that point.
Does
Good question.
depreciation only count as you're counted off as your taxes?
Correct. So, excellent question, Zach, and that's for a more advanced course than this one. But so to answer your question, yes. In your taxes for the business, there is a line item on your Schedule C for depreciation. And you would allocate the depreciation expense to that line item on the Schedule C for the business's taxes. Excellent question.
But you should always take care of it. Like you should always, I mean, not take care of it, but keep track of your depreciations
100%.
because you can count it off on your taxes. So that's why
Correct.
we should keep track of it as a business owner.
Correct. 100% correct. Yep. That's why it's so important to track your depreciation expense over time, because the business has the ability to use that as a deduction for the business's taxes at the end of each year. Excellent question.
Thank you.
You're very welcome. Yeah, good stuff. Talking about useful life, it's how long the asset is expected to be useful, right? How long can I use it in the business? Again, the IRS is very clear with how long things are supposed to last in the accounting world. We know, and Miss Edwards was alluding to this earlier, that dump truck, that's going to last me more than 5 years. I know that. At the end of the 5 years, it's technically not worth anything, but I'm still going to use it. It's just not going to be something that I can depreciate, because it's technically worth zero. Although I know it's going to last longer than that. Yeah, excellent. Good discussion. Any questions? Everyone's good?
So I guess it's just like a formula that the businesses use to make sure that they don't have to spend more to continue to use it.
You got it. That's exactly right.
Oh, one more quick question, Professor, please.
Yes, of course.
After it's no more use to the truck,
Mm-hmm.
does it, if it's still working and everything, does that automatically become an asset to you?
So the asset will have no value to the business, but you can still use it. It'll just be expensed out at that point.
It won't be an asset to your company?
No, because it's reached the value of zero at the end of the 5 years.
Oh.
Good question.
You can't sell that truck?
I could, and that'll be classified as other revenue when I do.
Understood.
Yep. Good question.
Professor, would this
Yes, ma'am.
practice be the same for, I know somebody said it in the chat, but housing, like a house, would you count the depreciation value the same way?
Yes. So with housing, yes. The building is an asset, and the building depreciates over time. The only thing that does not depreciate over time is land. The dirt itself does not depreciate. The building does. So there is a schedule for buildings in the IRS depreciation schedule. Yeah, great question. Everyone good? Okay. Awesome. Yeah, that's right. I forgot some of you are real estate people. So yeah, that question makes sense. But yeah, for the real estate business, yes, you would depreciate the buildings as well. The only thing that does not depreciate is land, because land is defined as infinite. The ground is still there. Yeah, excellent questions. Salvage value is, what is it worth at the end of its useful life? There's always going to be a value. Scrap value is also called salvage value. You know, it's like, oh, your car's worth $500 in salvage value or scrap value. That's how much the metal's worth, right? Yeah, that could be salvage value. Salvage value, it's really up to whatever the market is. There's not an exact formula for salvage value. It's called scrap value, residual value. Those are all their terms for it. So for depreciation, 5 years is the useful life. If it's a piece of equipment, like my dump truck example, 26,000. Let's say I have a piece of equipment for 26,000, useful life of 5 years. At the end of its useful life, it's worth 8,000. For straight line depreciation will be 26,000 minus 8,000 divided by 5 would get us 18,000 divided by 5 would be our salvage value per year, which would be where is it? I'm sorry. The salvage value per so it'd be 26,000 minus 8,000, which is 18,000. 18,000 divided by 60 months, which is 5 years, $300 per month would be the depreciation amount. So debit depreciation expense 300, credit accumulated depreciation 300 each month for 60 months. Straight line. Straight line's probably the easiest one to compute. There are other methods other than straight line depreciation. The other methods would include double declining balance is one method, and the other one is based off of market value. We're not going to go too deep into this class, into the weeds with depreciation. It gets very detailed. But the adjusting journal entry is debit depreciation expense, credit accumulated depreciation. That recognizes the depreciation consumption. Yeah. That's an adjusting journal entry we do at the end of each month or the end of each year. And this is the effect on the balance sheet over time. Okay, what about adjusting journal entries for the deferral of revenues? Remember, deferral of revenues is when the customer paid us before we provided the good or the service. It's unearned revenue. So in this example, we have a customer that paid us in 60 days in advance of the service. So what we would do is we would debit cash, credit unearned revenue to show the receipt of the cash before we provided the service. Then, when we after we provide the service, we would debit unearned revenue to reduce the unearned revenue, and we would credit revenue to increase our revenue. And this is what that journal entry looks like. Debit unearned revenue, credit revenue. And this is to record the earning of the revenue that we received in advance. Remember, on a journal entry of any sort, we have a debit account, a credit account. The two amounts always balance, and there's a notation and a date. For accrued expenses, for like an employee that's been working for us for 2 weeks, we debit wages expense, credit wages payable to recognize the accrual of that the wages for that employee. Debit wages expense, credit wages payable for the accrual of that employee's wages over time. Debit wage expense, credit wages payable. Then, of course, I'm going to pay that employee. You got to pay your employees. So when it comes time to pay them, you debit wages payable, credit cash. Revenue, accrued revenues. Accrued revenues, again, it's more rare than anything else. But we recognize revenue earned in a period of both unrecorded net yet received other cash. This is super rare, but it's kind of like you've received have not yet received the payment, but you have performed the service. You debit accounts receivable, and you credit revenue to show that you've earned the revenue, but the customer hasn't paid you yet. It's really not that rare. I mean, it happens. Adjusting entries, though, it's that part's a little rare. The future receipt of accrued revenues We debit cash, credit accounts receivable, and credit revenue. It's kind of like a partial payment. This shows us the relationship to the financial statements. So earned, unearned, those affect the balance sheet, of course. They also affect the income statement. In the accounting cycle, at the end of the year, we do this thing called an adjusted trial balance. Here's the way it works. On the left side, we have our unadjusted trial balance. These are just our balances on our balance sheet accounts and our income statement accounts. Then we make our adjusting entries. After we've made our adjusting entries, we have what we call the adjusted trial balance. And that shows the balances after the adjusting entries have been made. So it shows us what happened after we made all those adjusting entries. And we see that your debits still equal your credits. So everything's still in balance. Don't worry, I'm not going to drill you guys too much on the adjusted trial balance. It gets a little crazy. These are the steps to prepare the financial statements. So first thing we do is we prepare the income statement based off the adjusted trial balances. Then we prepare owner's equity. Then we prepare the balance sheet. Then we prepare a statement of cash flows. And these are how the financial statements are interrelated. Okay, some math. I know, sorry. It's not really math. Well, it's math. I mean, it's not like difficult math. Remember, a lot of the math that we're doing in this course, we're just plugging in the numbers. We know what the formula is, so we plug the number in. This one's called profit margin. This is a profit margin ratio. So important to know this. Why? Because as a business owner or as a manager or as an investor, I want to know how much profit I'm making. So how do we find out what our profit margin is? Profit margin is the profit from each sales dollar. We take our net income divided by net sales. Net sales, also known as net revenue. Net income divided by net sales gives us our profit margin. Obviously, the higher the profit margin, the better. Prepayment. So with respect to, then this kind of shows us what happens with the adjusting entries for the prepayments. We went through this earlier. This is just the appendix to kind of show you what happens with those adjusting entries. So the first entry we made was we prepaid our insurance up front, debit prepaid insurance, credit cash. And then at the end of each month, we debit insurance expense, credit prepaid insurance for the adjusting journal entry. That's the accrual-based accounting system. Alternatively, if you're using the cash-based system, you would just debit insurance expense and credit cash. And this just shows us the T account for that. And here's an example from that we looked at earlier. This just shows us graphically what happens based off of the adjusting entries for revenue. It's the difference between cash revenue and accrual-based. The T account. And that, my friends, is the conclusion of Chapter 3. We're going to jump into Chapter 4, which is a lot shorter, by the way. It's currently 6:40. I'm going to go ahead and stop the recording, and then we'll jump into chapter 4.